I've been in the process of trying to understand more, one, about just different like financial concepts and like vehicles. I've been trying to wrap my head around insurance, all types, from like medical to life to home. And I've been kind of like getting into some like estate planning, really trying to understand how to manage all these things, not just for now, but also for the future. So hey, everybody. I hope you all are having a great day, great Sunday. I'm here with Kadari Samaru. He is who helped me recently get mortgage protection on my home. And so today we are going to be talking about how I went about that process, why I went about that process, and Kadari is going to share some more information about how he helps people protect themselves. So thank you for agreeing to talk with me and my followers today.
Absolutely. Yeah.
All right. So a little bit about how we met. I was attending a home buyer workshop with Chad Murray, who I work with.
Phenomenal guy too.
Yep, he is. Shout out to Chad. And Kadari was one of the speakers at the workshop. And Kadari, share with the people what you were talking about at that home buyer workshop.
Yes, thank you. First off, I appreciate the invite, appreciate the space and the setting to be able to speak on not only the things that helped you, but in the ways that we both are looking to continue to take steps to help others, right?
Facts.
So with this workshop that took place with Chad reached out because he's a phenomenal realtor and does a lot of things in that space as far as educating and not only providing the service, but looking for something that goes alongside what he's already doing in that avenue. So in my take, coming in as a life insurance broker, wanted to come in and educate people on mortgage protection. So for ways that we can make sure we're protecting one of most people's most biggest valuable purchases. But at the same time, what are some other options for the mortgage besides just protecting the home? Like possibly being able to have a mortgage prepayment, like where you have something in place to, after a certain amount of years, you can take this additional capital that you've set aside to put and pay off the home early, or even having an investment tool to where not only is your house protected, but at the same time, you can use that tool to build up some additional cash that you can use and maybe put into other homes, whether it's a primary residence, a secondary residence, or a down payment for a kid's home, or anything going forward. But it never hurts to have some, not only protection, but also being able to leverage some benefits of that protection outside of just making sure the house stays in the family.
All right. Okay, so two of the things you mentioned that I would still trying to wrap my head around are mortgage prepayment versus mortgage protection.
Okay.
Can you elaborate a little bit on those two, the differences, and any pros and cons of one versus the other?
Absolutely. So when it comes down to mortgage protection, what you're looking for is you want to get a policy that is able to at least cover the amount of the mortgage for that period of time. Now, within that, there's two options. You can either get something that's term, which is temporary and it lasts for a certain period of time, such as 10, 15, 20, or 30 years. Since the traditional mortgage is 30 years, never hurts to have a 30-year mortgage to match and go in lockstep with that. So if something were to happen within that time period, somebody were to get sick, which we can speak to, but if somebody were to unfortunately pass away, they would be able to have that money that not only covers the mortgage, but has the rest of that money going to the family. Now, outside of that, you can also get a permanent policy, which will last for the life of the insured. And so if something were to happen too soon, or whenever that person passes away, the amount of that policy will still be able to cover the, if not, the remainder can go to the family.
Okay.
Now, when you mentioned also, so that commitment is, imagine if you had a plan in place and you have a 30-year mortgage. With this plan, at either the 15-year mark, you can get half of the money you paid into the policy back as a tax-free refund. Or at the 20 or even 25-year mark, you can get all of the money that you put into this policy back as a refund. So when I say mortgage prepayment, you can design this policy in such a way that at the 20-year mark, if you have enough cash that would be in there that would pay off the mortgage, you can prepay the mortgage and now you're in the clear. Or at the 25-year mark, you can prepay the mortgage off and now you're in the clear. And you can leverage it that way. So when it comes to people in home ownership, both of them are providing you protection, but the second option just having to also give you the chance to have cash to also pay that mortgage off a bit sooner.
Okay, sounds good. And then, so I guess one of my questions would be, what would cause a person to lean towards one option over the other? How does one go about like deciding on which type of insurance plan to get?
Mm-hmm. So when it comes down to picking, I'll say option A versus option B. Mm-hmm. Option A being something that we'll just say for all intents and purposes, let's say the mortgage protection plan is something that's temporary and it's a term policy. Mm-hmm. So it'll last for the general life of a 30-year policy mm-hmm. to match up with a 30-year mortgage. Mm-hmm. So that versus having something that would still cover them for within that period of time and giving them the option for the refund. I tell people it's not more so about what it is versus what it does. Mm-hmm. People really care about what are the benefits. Mm-hmm. So if you're thinking of something, they say, hey, if I get this and nothing happens to me, some people feel like I've wasted my money.
Right.
So on that mortgage protection plan, hey, you had this protection in place. If you never had to exercise it, thankfully you're still here and no concerns. Then it's like, well, what did my money go towards? That's one way of thinking. Mm-hmm. On the other side, you could say, well, not only could I have this protection in place as a just in case, but if nothing happens, I still have the option of accessing this money that I can use for whatever I want, whether you use it to prepay the mortgage and have that out the way or for some other endeavors. But really, the more benefits, the more the expense. Okay. So for example, it's the mortgage prepayment or the mortgage protection option mm-hmm. would be less across the board compared to the mortgage prepayment option, which might cost a little bit more because there is a cash component included to it.
Right. Okay. So mm-hmm. that was my assumption. So the primary, besides the benefits that one could get, the primary deciding factor may be like the cost of one type of policy versus another upfront.
Correct. If we're only speaking to just making sure that we are getting a policy in place, this is an insurance product offered by an insurance agent that is provided by an insurance carrier. Mm-hmm. As long as we are talking about just that, it depends really on what is somebody setting aside or able to set aside to cover which one.
Okay.
So I even had the comparison of, okay, you can have a Toyota, you can have a Lexus, and you can have a Ferrari, right? If I break everything down, the benefits wise, you might say, hey, I want the Ferrari. But if you have a Lexus budget,
right,
or you have a Lexus spending plan,
right,
then we should stick for where we are right now and then see if we have the option later on to be able to upgrade into that more luxurious vehicle, right?
Okay, mm-hmm. That makes sense. And so when I was listening to this presentation, it really piqued my interest because I've been in the process of trying to understand more, one, about just different financial concepts and like vehicles. I've been trying to wrap my head around insurance, all types from like medical to life to home. Mm-hmm. And I've been kind of like getting into some like estate planning, okay, as I'm like growing and securing like different assets, really trying to understand how to, manage all these things, not just for now, but also, for the future. So one thing I had been thinking about is, even though I am young, I am, I have a mortgage on our family home. And so I am the one, paying for that. And so in the event that something were to happen to me, because we never know, I would want to make sure that that burden of like paying off that mortgage is not left on someone else in the mm-hmm. family. So
to even chime in on that, mm-hmm. when we're talking about real estate, when we're talking about life insurance, mm-hmm. we speak the same language mm-hmm. on multiple levels. So for example, you're saying, hey, I want to make sure that if something were to happen to me, I'm making sure that a burden isn't passed along to the family. And that's a burden of debt or a burden of having to pay for things, the property taxes. Like there's so many elements that come to it. Mm-hmm. With life insurance, what this contract is essentially a guarantee that under these circumstances, this money is going to alleviate any burdens financially that may be passed on to the family. Mm-hmm. When you're even talking about building wealth, because when we're really thinking about it, this is a family home, right? Mm-hmm. We're dealing with family business, family assets. And if we're protecting these and we want these things to go from one generation to the next, how seamlessly and how much stress can we relieve from that situation in doing so? Mm-hmm. Both of these things can create wealth. But if you want to take one asset, such as the home, and you want to make sure that's being passed along with life insurance, even having a difference in that, we can make sure the home is taken care of and more money is flowing from one generation to the next to go into an estate mm-hmm. that we could then make sure that we're designing this in a way that where generation after generation can continue to have like a snowball effect. It just gets bigger and bigger going from one end to the next.
And that's the goal. That's the goal, is to have, not only for us to make some money now, but to have some extra that we can pass along so that, we're not always starting from ground zero.
Correct.
Each generation. So on that note, I did end up getting myself a policy.
Sure did.
And Kadari will even help refresh me on the policy that I ended up getting. And yeah, just some of the things that I decided in relation to the policy and the goals that I had for myself. So do you need any of this, or do you remember off the top of your head?
I'll try to tap in. Okay. I'll see if I can get it off the top of my head what we were going to. But I guess to refresh me and to make this very clear for the audience too. Whenever you're coming down to making a plan, it really matters what is the most important thing to you financially. Throwing a couple things out there and then prioritizing them. What are your saving habits? What's your savings and your money philosophy? And then coming up with what you want to make sure that you are accounting for. Because at the end of the day, what this could serve as is a foundation. You want to have a solidified foundation for everything else to be built upon. So when we had the conversation, you said, hey, I want to make sure, because mortgage protection was the most important thing to be able to start with at this phase of your life. Okay, let's make sure that we find out how much the mortgage is for, and then find a plan that's going to not only be able to cover the full amount of that mortgage should something happen, today or, too soon. But what if nothing happens and then you still have life to live? What are the other benefits that come along with that? Is that fair?
Fair.
Right. So the other benefits of the permanent life insurance policy that we came up with for you was that we don't know how long we're going to be here for, right? So the home will be paid off, everything will be taken care of, let's say 30 years. There is a very small chance, right, that anyone is making it up to age 121. Is that maybe fair to say, right? I said, unless you know Moses, he made it to 120. If we happen to make it past that, listen, we got to maybe sell some secrets on how we did that. But these permanent insurance policies, when designed correctly, could last you up to age 121.
Okay.
Essentially, this is a guarantee that this money is going to be passed on from one generation to the next, or for wherever your beneficiary or beneficiaries are, whoever you decide to get the money.
Yes, and to jump in on that, the reason why I decided to go with a permanent versus a term is because when I really came to understand the difference of the two, with me being a more risk averse person, generally speaking, I was kind of thinking kind of how he mentioned earlier with the term, it expires, after a period of time. And if nothing has happened to me within that period, it kind of feels like I wouldn't have been really putting my money toward anything. So I just decided, even though, people have options, they can start with a term and then kind of move to a perm later. And that maybe that's something you could discuss after. But I just kind of decided to go with the permanent upfront because that just made the most sense to me in my mind.
So not only in this option does it last up to 121, really people think, okay, well, what's the difference between the two? The term one, you can get a lot of coverage for a little bit of money, right? The permanent one, it costs more, but what are the other benefits? So not only are you protecting the home, protecting your assets, but while you're paying for this policy and putting that money into it, you're allowing a tax-free cash savings within the policy to be able to grow month over month. So what does that mean? We're all familiar with the S&P 500, which is the stock market index, top 500 companies, your Apples, your Googles, your Microsofts, etc. Now, when these companies do well, the index appreciates, which means that it grows and you're able to get the ups of the market. So you make money when the market makes money. But when the market goes down, traditionally, if you're in the stock market, in the S&P 500, if you have money exposed to that, what happens? You lose money. The way that these policies are designed is that you get the ups of the market. So when the market's up, you make money. But when the market goes down, you don't lose anything. So you have a floor. So if the market goes negative, your money doesn't go negative along with it. But when the market starts to go back up, you get to go up with it too. So just thinking about where are the places that you can take your money to not only protect things that could make you money in your household, but you can take money that makes money. right? And that's what this option was, something that made the most sense to be able to do. On top of that, not only can this money be able to grow and protect your assets, but it also gives you the opportunity to, it's tax free. That's what I was looking at. I was like, okay, what's the other benefit, right? You could take your money and put it into a lot of places, but where are you able to put your money today that over the next 5, 10, 20 years, you're getting the growth of the money that's there without having to pay taxes on it.
Right. Love it. Love it. So that's what I decided on. And let's see. Okay. So for understanding a little more about my specific policy, there's no like downsides of like sharing this information with people, is it?
I mean,
about,
if however comfortable you feel with what it is that you have in place for yourself.
Right. And this is just like a starting point. As I learn more and gain more, I will definitely be interested in like upgrading my policies and like getting more, just to, like do different things. But this is where, I decided to start based on what I'm looking to achieve at this moment.
This is a starting point. I think that, of course, me being in the industry, but one of the truths of the matter is that you can't go buy life insurance like a cup of coffee. Right. You can't just go say, hey, I want 2 terms, I want 1 perm, and then all of a sudden it's drafted just like that. Just as our process, we have to go through, we have to develop an application, we have to get some information to where not only is it being reviewed by a case manager, an underwriter, but it has to go through several steps and figures while they have to look into everything from criminal history to your motor vehicle report to your medical history, and you have to make sure everything lines up and that it's suitable for the client. Right. So after checking all these boxes and going through that application process, then we have the ability to be approved, or more information has to be developed to find out which direction that we can go in. So with this being the starting point, you're talking about you wanted to start off with something that's permanent, but as long as you're healthy, it's still suitable, you can still apply for more policies. You can get more permanent, or you can even add a term policy on for the meantime to do what you mentioned earlier. You said you can convert it, or what I said was you can upgrade it. So once you lock in that term policy, let's say you get it for 30 years, you have 20 years from when you first got that policy to be able to upgrade it. Right. So you might say, you know what, I want to get a $1 million term for right now. 10 years go by and you say, you know what, I've paid off the house, I made some extra money, I've done some things, I want this to be working for me at a greater capacity. Excellent. We can take a portion of or all of that $1 million term at that point and then upgrade it into something permanent so that you can get the added value of building up some cash inside of that policy and having something that's guaranteed to be there for you for, as long as we're here. Right. Okay. So when we say upgrading a term, would it be that, like you said, $1 million, would it be that $1 million, let's say if we were to upgrade the whole thing, that $1 million benefit that you would have been getting under the term parameters, when you upgrade that, now would it still be like, at least to start, that $1 million benefit under a permanent, and then all the other benefits that would come along with like it being a permanent policy? Yes. So once you can either convert a portion of, let's say you can convert as little as 100,000 of that million up to the full $1 million. Okay. Whatever the difference is. So let's just say, for example, you want to do half and half. You have $1 million term. You want to convert 500,000 into something permanent. Okay. Whatever the term is, it'll be reduced from 1 million to 500,000 and whatever that is. And now you have a separate policy that's a $500,000 permanent policy that we can design to work in whatever capacity you want it to work. Hey, I want to have this over here. I know it'll grow some cash. I'm not so worried about that. I just want to have the protection. Excellent. Let's design it that way. Or you say, you know what? I really want to take advantage of growing some tax-free cash inside of that. Excellent. Let's design that so that it could more so work for you. So that snowballing cash is getting bigger year over year sooner than if you were just like, just focus on the protection and not so much the cash in the beginning. Right. Okay. That makes sense. Thank you for sharing that. Okay. So now digging a little bit into the personal policy that I've gotten. It's called an F&G Everlast. That's just the title of it. They got a little summary information about myself, I guess what they used to help qualify me. The face amount
is $235,000. So that face amount, what does face amount mean?
Face amount is your death benefit.
Okay.
So God forbid something happened to you, that is the amount of money that is going to the family as of today.
Okay. And then death benefit option, it says death benefit option B, in parentheses, increasing. What does that mean?
So there's two options that you can have for your policy. Okay. There's a level benefit and there's increasing benefit. But the level benefit, the amount of the face value is going to be level. So it's going to be consistent throughout every year of the policy. Okay. So right now it's $235, year over year to be $235. The only time that in a level benefit, the benefit will actually change is when the cash that you're growing inside the policy starts to get close to that $235. Okay. Right? Now with an increasing benefit, the death benefit or the face value is increasing as you're paying into the policy. So year over year, you start at $235 as you're putting that cash, and that cash is growing inside the policy. It's growing inside and it's pushing the death benefit up. So to go from $235 to $250 to $300 and so on, as long as you're paying into it, that cash that's growing inside the policy is kind of growing on top of the face value. Okay.
So then the next thing we show on here, it says my initial premium is $100 monthly. And how we got to that number, that was the number that I said I could allocate to this goal at this time. So we structured my whole policy around me being able to put $100 monthly toward it. Okay, so I mean, besides that, what is the initial premium? Tell us more about that.
So right now, what we're doing with that, we chose a number that not only could we make sure that this policy is going to last for the lifetime. So based on what it's currently showing right now, for $100 for her is going to last up to that 120-year mark, as long as things continue to develop in the way that they're developed now, right? The beautiful thing with these right now is they're also flexible with the premium. So we chose a number that made the most sense to make sure that it doesn't lapse or cancel early, but at the same time, that money is going to be able to also grow for you. So that money also could take care of some monthly premium down the road if something should happen and there was a shortfall. The beautiful thing is too, the way the government set things up, right, is that if you're going to be able to leverage something, at least in this capacity, leverage something that's going to be able to grow tax-free, the larger the policy, the more money you can put into it. So right now it's at $235, we're doing $100, but you may have a cap of being able to put up to, let's say, $400 or $500 a month into this, because that additional money is going to make that snowball of cash that's inside it grow even faster. So there's a cap to it. So if you had a bigger policy, you might be able to do $1,000 a month. But starting at that 100 over time, you're still going to be able to grow and to accumulate some cash. But you can always, let's say, a tax return. You have a very favorable business deal that comes in. You have some extra cash, and you're saying, well, I already have my $3 over here to the side. Put it into something where it's going to favor me and favor some of my longer term goals. Let me go ahead and start now so I can get that money to start working more into my favor.
Okay, and how would one determine what that cap is for how much they? So the cap means what? Like how much you can.
How much? So the cap that you're putting on there is how much money can you put into this policy with maintaining the tax-free access benefit. Okay. Because if you put too much money in, now you've violated the rules, right? They're kind of like, hey, listen, like imagine if somebody had a $100,000 policy and they put $1 million a year into that, and all of that money is growing on top of itself. It's growing and growing. It's compounding year over year, and it's tax free.
Right. So there's only so much tax free benefit they're going to allow you.
Yeah. The bigger the policy, the more that you could put into this. So that's why I say when it comes down to designing, you have to have that conversation of where are we at? What's the priority? What can we start with for now? And then you can grow into it. It's kind of like you ever seen like, a niece or nephew, or maybe growing up, your parents might have bought you some clothes that were a little bit too big.
Right.
But that is, you'll grow into it. Right. And now it's not too big to where you can't wear it today, but it's big enough where it still gives you some leeway. That's maybe a great way of thinking about it. So when we started with this is what we can start with for now. And you still have room to be able to grow into that. And then as your finances change, as your priorities change, as things that are within your financial, that are financially important to you, as those develop, then we can always get more protection to match that.
Okay, cool. And then, so the next thing I see on here that we'll probably get into a little bit later are riders. There are 4 riders that I see with this policy. So we could talk about those a little bit later. But I have several other terms here that I want to make sure that we elaborate on.
Well, if you don't mind, I would love to, because a lot of those riders kind of overlap.
Okay.
But what I even spoke to at the home buyers workshop also speaks to what I said, that is so extremely important and so extremely valuable. From the economic education standpoint, one of the most informative areas of what the insurance provides, and what I think is extremely overlooked by a lot of people, is what is the need for long-term care. So when I say that, long-term care is if anybody knows someone who's had cancer, heart attack, stroke, some sort of critical or chronic illness, especially coming out of the pandemic, just thinking about people getting elderly, people aging, and thinking about our elder community. Nobody really thinks about what is the potential amount of my medical costs. If I were to ask you, what is the number one cause of bankruptcy, what would you assume it to be?
Number one cause of bankruptcy, I would probably just say, well, obviously like debt in general, but I don't know. I might think like a mortgage or student loans or something like that.
See, so you're thinking that, okay, probably it's the thing that's obvious because you're paying for it today, but nobody's thinking on the road it's actually medical costs. In Florida, and around the country, the average is around 6 figures, but in Florida alone, the average long-term care today is around $117,000 a year.
Wow.
So in another 20 years, I think it's expected to be $212,000 a year. So when we're thinking about all the things that we want to plan for, we want to have our stocks, we want to have our real estate, we want to have our crypto, we want to have cash, you want to have all of these things that are moving along. However, if you have a $100,000 responsibility now, and you're looking at how you're going to pay for it, where are we going to get this money from?
Right.
Most people go to, okay, savings, gone. 401k, when people retire, it's on average anywhere from $200,000 to $300,000. That's gone, right? In a couple of years. Right. You're looking at your real estate. If you have a secondary property, are you going to sell it? Are you going to have to downsize? Are you going to sell your primary home?
Right.
These are things that when you're looking at, is you didn't acquire those things to have to use them for medical cost. Like that, I don't think that was the goal. Like, hey, I'm gonna have this house so I can sell it in case I need that.
Right.
So if you can have something that's not only protecting your assets, but it can also protect the most valuable thing that we have, which is our health, or at least the cost to be able to maintain that. Keep the main thing. Having something like this in place, you can use up to a majority of that money while you're alive to cover the medical costs. Because when somebody's sick, like, do you know anybody who's had cancer, heart attack, stroke, something along those lines?
Yeah. Uncle had a major stroke.
Major stroke, right? And that's unfortunate to hear. Was he working at that time?
I believe so. I'm not totally sure. I don't recall totally, but I believe so.
So if there was a chance that he was working, there's also a good chance that whatever his income was relying on to keep everything moving from month to month. Let's say he even had 2-3 months worth of savings. Okay. How long is the recovery process? When will he be able to get back to work? Nobody knows, right?
Yeah. He never recovered. So he's having to, have that care essentially, for the rest of his life.
Now, imagine if when you're going through that, the mortgage does get paid, car insurance, you still got to get food, phone, internet. Like, life is still going to continue. They're not going to say, hey, we heard you're sick.
Right.
You can go ahead and pause your payments for the next 6 to 12 months. It doesn't work that way. But if you had a plan in place, for the meantime, you can buffer the burden by having something like this in place to where you can cover the medical costs. And I mean, I've been at elder care workshops. I went to an elder law firm, and one of the attorneys she spoke to, she said, I'd love to be able to give you the options that you want. But that takes finances. So it's like, if you want to maintain your dignity, if you want to be able to maintain your control of how you want things to do, like, okay, hey, I want to stay home. I want to be able to get that care in the house, but that comes with a cost.
Right.
So beyond everything else, not only is this insurance protecting you if you were to pass, but you can use it while you're alive. And not every insurance carrier is the same.
Mm-hmm.
You know, being a broker, getting to work with the top insurance carriers in the country, the ones that we've chosen to partner with tend to, or all of them do, include the living benefits, which is, like I said, that's not a staple across the board for everyone to have. So something that if you do have life insurance or you're considering life insurance,
Mm-hmm.
ask the question, what kind of living benefits do I have? And that's whether you're getting that through your bank, whether you're getting it from your job,
Mm-hmm.
wherever you have this policy from, look into what kind of living benefits do I have.
Very important. Very important.
Mm-hmm.
All right. So we're going through, I think we're just going to go through my narrative summary, which may cover some of the things that we already talked about. But just to make sure that everyone understands some of the things that you might see on your own policy. So the first paragraph, it gives a little bit of a summary of like the specific product that I have. The next paragraph, it talks about monthly no lapse premium, and it states that the monthly no lapse premium is the minimum premium required during the no lapse period to keep your policy in effect. And it just lets me know that mine is $46.22. Mm-hmm. So does that mean, and then I'll just read a little bit more of something else that's highlighted. If you pay the no lapse premium, the guarantee period is to age 44. Mm-hmm.
So to clarify on that, mm-hmm. There are different levels that you have in a policy. Mm-hmm. There's the bare minimum, mm-hmm. the no lapse premium. They're saying, hey, if you pay this much, mm-hmm. the bare minimum for this period of time, it'll last you guarantee up to that amount.
To age 44.
Correct. That's the guarantee is what it's saying based on that bare minimum number.
Right.
Then there's the amount that we designed the policy to pay, $100 a month. Okay. It's affordable for right now, based on the way the market's expected to do returns, mm-hmm. Based on the cost of the insurance, everything. That 100 should be able to get us way through the finish line that we're looking for.
Okay.
Then there's the maximum, which I spoke to earlier. You have the bare minimum, get you to a certain extent. Mm-hmm. There's the amount we designed it to, which is going to be able to allow it to at least last for the life of the insured. Mm-hmm. And then there's the maximum amount, which is the maximum amount that you can put into the policy to still guarantee you still have the tax-free access benefit included in the policy, and your cash does not become taxable.
Okay. Mm-hmm. Thank you for that. So then the next term, we have a guideline premium limitation. The guideline premium limitation is the maximum premium allowed by the Internal Revenue Code. Mm-hmm. And it says the guideline premium limitation is the greater of the guideline single premium or the sum of the guideline level premium as of the date of the calculation. Mm-hmm. The guideline level premium for this illustration is $5,387.26. Mm-hmm. Okay, what does that mean? The guideline level premium for this illustration is $5,000.
So if anybody's at home with a calculator, mm-hmm. they can take that number that she just said and you divide it by 12. On a monthly basis or over the course of the year, that's what the amount of money that would be the cap that you can put into the policy. Okay. And design it as such.
Perfect. Target premium for this illustration is $1,048.10. Mm-hmm. What is the target premium?
Target premium has been best designed to say that that's the cost of the insurance. Okay. So if you have that amount there tending to be, the target premium tends to be the amount that will normally get it through the life of the policy, but that can always fluctuate from carrier to carrier, because each carrier could vary based on the cost of their insurance. Mm-hmm. So that's why sometimes it could be a little bit more per month, it could be a little bit less, but for the most part, that's what the cost of the insurance is.
Okay, so what does that mean for me or to me? Does that mean anything in specific? What would I do with this specific information, or what could I do?
I would say because these policies are designed, right? That's because everything goes back to when it comes down to the permanent ones, mm-hmm. Another difference between the two. A term policy is literally plug and chug. Mm-hmm. I plug in your numbers and your information, it comes out with the number. That's mm-hmm. just how it is, right? This one here, just like how we said that the no lapse monthly premium is $46 and some change, and mm-hmm. they were moving it $100 a month, but yet you have that cap. We're looking to find a number that is making sure that it is going to be there to serve you in the purpose that you're serving, right? Mm-hmm. So the target premium for, I would say, the consumer doesn't matter so much, right? Okay. It's really a matter of what is going to give us what product is going to give us the best result based on where we currently are today and where we're looking to go in the near future, or even for
benefit, which we talked about. They kind of described that a little bit. The initial death benefit being the $235,000. Then, of course, they let you know the actual amount payable at death may be decreased by policy withdrawals, outstanding loans, or increased by additional insurance benefits purchased.
Do me a solid there, because I see at the bottom of the page. I said it earlier, but I want you to read the definitions for the death benefit options for option A, which is level, and then option B, which is increasing.
Okay, death benefit option A. The death benefit is the greater of the face amount or the account value multiplied by the death benefit ratio. Option B, the death benefit is the greater of the face amount plus the account value or the account value multiplied by the death benefit ratio.
I was curious what the definition is right there. That one's this is a contract, right? So sometimes the contract language, you're like, what? What exactly does that mean?
Exactly.
It just goes back down to what I said before. It's the greater of one of the two numbers. Level is level all the way until the cash in the policy gets close to it. Then it starts to be able to grow. And increasing is the greater amount of your death benefit continues to increase as the cash increases too.
All right. And then it gives us a few more terms, which I'll just read just for my knowledge and some others. Face amount. We talked about the face amount. Something I think that's interesting about it. It says the owner may increase the face amount after the first policy anniversary. An increase requires proof of insurability and must be requested prior to the insured's age of 81. Face amount decreases are allowed after the third year of the policy. So it pretty much gives me some guidelines around when I can make certain changes to the policy.
Correct. Because in the insurance carriers, most of the mindset is, if we're going to offer this to you, because some people say, hey, can I just increase it later? Question, because then you may have to go do another application, because they want to know, okay, well, why are you increasing this? Has anything changed health wise or background wise and so on? Versus reducing it, the insured is reducing the coverage, because then that's less of a responsibility on their end. But in knowing that, and then that also can vary from carrier to carrier as well, as far as when you can do it. Can I reduce it in the first year, in the third year, and so on?
All right. The monthly deduction. Each monthly deduction consists of the monthly cost of the insurance, express charges, any charges for additional benefits provided by writers, and any charges for substandard premium class rating. Okay, so what do they mean by monthly deductions? What's a monthly deduction?
So that is the amount that is being deducted on a monthly basis from your whichever account you selected to have the premiums drawn.
Okay. All right. And then the last thing, partial withdrawals. The owner may make partial withdrawals after the first policy year up to the available withdrawal amount. There is a $25 withdrawal fee for each withdrawal, and the minimum withdrawal amount is $500. So what do they mean when they say a partial withdrawal?
So, as I said, that you have a tax-free savings account that's within this. The way that you're able to access that tax-free is by taking a loan. I guess I'm just looking at how do I keep this as simple as possible. You can withdraw the money, which is like debit, take it straight out, or you can take a loan from the money. What they're speaking to there is more so just debiting the money.
Right.
So if you're putting that money in there, because I told you this is also growing based on the S&P 500. So let's say you have a phenomenal return, and let's say you get a 8% return. You've been putting the money into it. As long as it has crossed a certain threshold, as far as, okay, you've made enough money, you've put enough money into it, and it's grown that certain amount, you're able to take a withdrawal based on what they're saying is up to, it has to be a minimum of 500 to, as long as it's available, you can be able to withdraw that money.
Okay.
Now, the difference between a withdrawal and a loan is, if you withdraw the money, a withdrawal can be taxable.
Oh, okay.
A loan, though, however, is how you're able to access the money tax-free.
Yes. And of course, as we know with the loan, you're supposed to be paying it back.
You're supposed to be paying it back. However, do you have to pay it back?
No.
There you go.
Okay, love that. Okay, so I guess now I do have a few more questions. We should cover what the riders are. What do you think?
What do you? I would say go with your questions because I would say right now because if you get into it, I have a couple of friends that are attorneys and they scrubbed it and they're going. They let 100 is it's split. Okay. How exactly it's split, it varies from carrier to carrier. Mm-hmm. How the market is going to perform, trust me, if I knew that, I'd be in a completely different space. If I just knew, hey, the market's going up, let's do this, the market's going down. So really, we don't know how the market's going to perform, but we can look at the history of how the market has been. So if the S&P 500, for example, has returned 8% for the last 30 years, it's maybe safe to say that over the next 30 years, it's not going to do 0%. Right? Over the course of that time. So it's based on how the index that's selected performs. Right. I don't recall exactly the specific index for this one, what the cap is, mm-hmm. but let's say that this product can do 9%. Let's just say 9%. I was going to say 9.25%, but let's say 9%. Mm-hmm. If the market does 11%, you still capture 9% of that market. Mm-hmm. So that's the cap. But let's say the market is -5. You're at 0. Mm-hmm. So you'll never lose money. Mm-hmm. Insurance is the only market in finance that has not lost money in a recession, depression, or a pandemic. So we're guaranteeing you not to be able to lose money, but you can participate in the upside. Mm-hmm. So whatever the money you're putting into it, whether it's the $100 or whether it's up to that maximum to still maintain your tax-free benefit, that is the money that is not only paying for the insurance. Anything additional above that 100 would more so be going into that tax-free bucket that's snowballing, that's growing month over month, year over year.
Right. Okay. Mm-hmm. And so what I'm hearing is of this $100 that I'm paying monthly, some of it is pretty much going to the expenses of the policy. Some of it will be growing.
Yes.
All right.
That's so much more simply said. Yeah, I should have said that. Right.
Yes. And then I think, so that's another thing that kind of intrigued me or maybe advised us to like invest our money in. Essentially to like make it work for you, mm-hmm. the stock market or different like, I don't know, variants of that people suggest. But of course we know that there's like risk with investing in the stock market and that, you know, you can lose money, that being like one of the major and scary risks. Mm-hmm. And so, yeah, that's something that I found interesting about insurance as well, where you can, you know, get the benefits of investing without the losses. So
that is what's in there. There are guarantees mm-hmm. in insurance. I can guarantee you that you won't lose money. It's a 0% floor. They say there's a phrase, 0 is your hero. Mm-hmm. If you're looking at the market may do this, and over time it's going to perform extremely well. You're going to ride the wave up, it's going to go down, it's going to go up, it's going to go down. If that was your money in the stock market, you're hoping that whenever you want to access the money, you're on the upside. But we just never know when it's going to take that curve and how bad that curve is going to be. Mm-hmm, mm-hmm. 7 out of every 10 years, the market is up. Mm-hmm. So you're like, oh, okay, that sounds great. 3 out of 10, the market is down. You don't know how down the markets are going to be in that time. Because mm-hmm. what if you have 7 years of up and in those 3 years it sets you back to how it was in year 1? Right. So you go up 7, you go down 3, you're back at square 1. And nobody has a crystal ball that I know of that they can access that. So as far as looking at ways to diversify your portfolio, diversify your money, and you want your money to make money and to put it into different spaces, there's no reason why I don't see insurance being the foundation that you can build upon, because everything can either fall down to that if the market does crash, or you can be able to build up from there. The market's doing well, you have some cash that you can use for whatever your reasons are.
Yeah. And these are things, and when I say these, I mean like benefits of insurance are, to me, don't seem like are talked about enough or understood enough. Mm-hmm. And I'm curious as to why that is. So if y'all have some answers, or if something that is being said here today is wrong, please let me know. Because like I said, I'm in the process of learning and understanding all these things. But Kari, why do you have any thought about why you think? I feel like, yeah, specifically the benefits of insurance are not as widely like talked about and understood as they should be. Why do you think that is?
If I were to say, it's that when you think of it, it's the way that it's been marketed. It's maybe the best way I can put it. Because when you think about insurance, right? What fifth grader do you think will say, I want to grow up and sell life insurance?
Right. Nobody.
It just doesn't come, it's not sexy. It don't sound like, oh man, I really want to do that. However, when you think about the lifestyle, if you start getting into it, if I were to say which industry has created the most millionaires, and you sit there and you think about this one and this one and this one and this one, I'll save you time. It's financial services. So you're thinking about, okay, well, I want the things that they have, but you're just not aware of it. But why I think that it's comes down to marketing. Honestly, I think that a lot of people tend to leave that for one, they think of life insurance as death insurance, right? So automatically it's just not the most attractive when people don't want to have this conversation of thinking about their passing. So something people tend to put off, they tend not to put a lot of stock into because nobody really wants to think about the end until they're closer to the end,
Right.
generally speaking. So I think from a marketing standpoint, from the lack of knowledge and information, I think it's just not put out there as much for as many people. At one point in time, we used to have a smaller population as a country, and we had many more insurance agents. And now that's flip-flop, where we have a much larger population, and we have even smaller number of agents that are perpetuating this information. So it's like, why aren't people more aware? Well, we have more people that need the information and less people that can pass it along.
Right.
So I think that you're looking at the supply and demand of things. When you think about the way that things have been marketed, it makes it more difficult for the masses to be able to adopt this way of thinking to say, you know what, let me go ahead and get that and start now so that I can think from a longer term standpoint. Let me start as early as possible so that this money can serve my family and my last name for as long as possible. I'm talking, why not? Why aren't there more families setting themselves up like the Rockefellers, to where they have one generation after another, after another, after another, passing on tens of millions of dollars from one to the next, to take care of education, to take care of business endeavors, to take care of housing, and to have control, and to have structure, and to have land, and to have all of these things that continue to provide lives and lifestyles that many people dream of.
Right. I would definitely say one of the things that I have been learning and talking or realizing in conversations with certain friends, that a lot, if not everything, it comes down to marketing for sure. I feel like a lot of the things that we know culturally or that we believe culturally is really just merely the result of good marketing and really nothing else, nothing deeper than that.
Right.
So yeah, this is something that people should know or really understand and accept as business owners or just as people in general. Like, marketing is really powerful. So yeah, and on that note, I feel like too, a lot of things that are marketed well, that will, let's say, the massive corporations or the powerful people, the things that they really want us to know, I don't know, are they the things that are truly beneficial to us? I've been questioning that as well. I feel like the things that are really good, people try to keep it on the low. So
well, I mean, it can get interesting because it's how come you have a $2 bottle of water, 50-cent can of soda?
Right.
It's like, I would admit the water's better for me, but what's not as good for me is so much more accessible. Interesting how that works, right?
Yeah.
But the positive side of that is that when you have information able to a lot of people to get so the demand is there, but the supply is low, it's nothing but ground sharpness. And I don't know. I think that there's a chance that someday it's going to change, because I know that some of our aspirations are to grow massively. Like, we're looking for great people. We're looking for those who are looking to be able to learn for themselves, even if it's on a part-time basis. Like, you go to school, you spend all this money, going to college and getting certificates and doing all these different things to possibly still not know what you're looking to make out of life.
Right.
But if we want to study the things that are most important for us and for generations to come, like making a significant impact, I mean, right now the money has the money, right? That's really the ones that can really make some things happen. So Jay-Z said, I can't help the poor, from one of them. So I think that there will be a changing, a slowly turning of the tides as far as people wanting to become more financially literate, to become more economically powered, to seek this education in regards to money and finance, and to be able to make sure that, truly we're moving one generation to the next in a much more favorable and significant way.
Love that. That's definitely one of my goals for sure. All right, so getting back into what we were covering in terms of what are in my specific policy. So we still have some of the riders that we can describe in more depth, but right now I'm looking at this numeric summary that has some guaranteed assumptions as well as some non-guaranteed assumptions. So I guess we'll go based off my assumption that what they mean by assumption, if all goes well or as it should, these are some things that will happen for sure. And I guess for a non-guaranteed assumption, these are some things that might happen.
So the simplest way to explain that, when I'm sitting with the client and they're going over that, because they're going to look and you're going to see different numbers for different areas. And you're saying, well, the guarantee is only going to last me this long. And then the assumption is going to last me this long. Which one do I have? Once again, nobody has a crystal ball. So we can't say that the market is going to perform in this way every single year, year over year. However, we can always draw back to the past. We can always look and say, well, based on what this index, such as the S&P 500, has performed, it's returned at least this amount for the last 30 years, for the last 20 years, for the last 10 years. We can look and see what it's done. So we can't exactly detail what's going to happen in the future, but give or take, we can use past information to be able to predict some level of future performance.
Okay, so the numbers in this table are based off of historical data.
So those numbers, there's a guaranteed amount where you have what is your guaranteed rate of return? So the guaranteed assumption versus the alternate assumption, which is the amount that the insurance company is comfortable with saying that, hey, if it were to return this percentage amount month over month, these are what the numbers should look like. And then the midpoint is something in between. Now the S&P 500 has returned anywhere from 5 to 8%. Mm-hmm. So if we look and we can comfortably say that you'll get at least a 5 to 8% return. Now, some of these can have higher caps. You might be able to get a 9, 10% return.
Right.
But is the market going to return 10% year over year? Very unlikely. Is it going to return? We're good. Oh, is it going to return 10% year over year? Not likely. Is it going to return 0% year over year? Not likely. Mm-hmm. So these numbers are just somewhere in between to what is the guaranteed amount that you can cover versus that alternate amount, which is what they're comfortable with saying that you could see these numbers right here. And then picking a number in between just to show you that these are possibilities, which is why I go back to keep saying that it all matters about how are these designed? Right. Are they set up in a way that based on history and based on how things could look going forward, there's enough money in here to satisfy not only the insurance, but to also be able to grow for you to be able to use it for whatever you like.
Okay, so we have first column, it shows us the year. So we're going to start with year 5. Next column, it says a premium outlay. And for year 5, the premium outlay is $1,200. So, okay, so I think I have an idea in my mind, but can you tell me what a premium outlay is and what this $1,200 premium outlay?
I'll help you with that. And then just not to knock the intelligence of the audience, though, getting into numbers could be splitting hairs. Just before breaking out all of these. But your premium outlay, you're paying how much per month?
100.
100 times how many months in a year?
12. So
your premium outlay would be how much that you're paying each year.
Yep.
Or the total amount that you're paying for annually.
Right.
Is showing right there.
Perfect. So guaranteed assumption at year 5 with my yearly payment of $1,200, surrender value would be 0. Net death benefit amount would be $237,000 and some change. Mm-hmm. Surrender value 0. What is surrender value?
Surrender value is the amount of money that you have access to.
Okay. Mm-hmm. So at year 5, I personally would not have access to any. So by access, I wouldn't be able to withdraw any.
There wouldn't be cash enough available for you to be able to withdraw it if you're only paying that amount.
Right.
Because once again, the guaranteed amount is only going off of the guarantee, which is why it can appreciate over time, but it's appreciating slower because normally it's not really giving you much of a rate of return while also covering the cost of the insurance.
Right.
But with some of those higher numbers in returns, is showing you it's getting more closely to what the market actually can perform. And then once again, that's only going off of 100. But as your income increases, as the demand changes, you can always, like I said, go from that 100 up to even a little bit higher to be able to have that money be more favorable for you, because you're, like I said, you're feeding the snowball, right? So as it's growing, the more money that's in there, the faster it's going to grow. The more money that's in there sooner, the bigger that amount is that can grow from year 1 to 5 to 10 and so on.
Right. Okay, perfect. So at year 5, paying my $1,200 a year, I would not personally be able to withdraw any money, but that money would be in there growing. So even though my face value or my initial amount is $235,000, if I were to pass away, the amount that would go to my family would be $237,415.
Based on that, yes.
Cool. And then, yep, like he said, they have like the alternate numbers, which of course are higher. So with with an assumption of like a greater return at year 5, I could possibly be able to like withdraw like $943, and my net benefit amount would be even higher.
Mm-hmm.
Perfect. Okay.
Let me ask you this, because we can get into this, because we'll have this conversation.
Mm-hmm.
Why life insurance for you? You want to protect your household. How do you think your life is going to evolve over the next 5 to 10 years to where this could be more important for you? Because initially it's, okay, we're looking to protect the household. Household's protected, right? You're going to have an avenue over here to be able to do some things. You're going to grow in your entrepreneurial endeavors, and you're going to do some things. But based on where you're at, maybe where the audience is, and maybe they're thinking of starting something, this isn't a short-term game plan. This isn't something that we're looking at like, hey, okay, cool. Well, what can I have in the next year or two? How can I leverage it in the next year or two? While you can, most people aren't in that space. They're looking, this is something that I can start now, so that, 10 years from now, 20 years from now, that person's going to look back and be proud of the decision that they made. But I guess for you, what does life look like for you in 5 to 10 years? And how could this benefit, or how could this part of your plan be benefited for that person?
Yeah, so one of my goals for the future, that I'm kind of planning for or thinking about different ways that I can reach that goal sooner, is I want to invest into real estate. That's one of my big goals, is to get into real estate investing. And I think that even just feeds into like a bigger goal of how can I increase my streams of like passive revenue, so that I don't have to or just so that I don't have to work as much, and I can use more of my time to do more of the things that I want to do. So that's really my goal, is to more immediately, get into real estate investing. So that's something that I would be looking, again, to get money to leverage or those type of things. And then on the longer term, how can I just get access to more passive income?
Okay. All right. So you can see how life insurance can bring you money passively. You can see how it can, not only could it be passive, but it can also be applied to investment goals. You can also see how you can have money, make money, which also gives you more of the most valuable thing that we have. Like I said, well, I guess I've said that twice now, but we have time and health. We don't know how much time we have, but we know that if we have the greatest amount of health within that amount of time, probably have a better quality of life. So is it fair to say that you can see how this, starting now, the sooner that you start, the better it could increase your quality of life 5, 10, 15, 20 years down the road?
Absolutely. And one of the most important things to me, again, is how I can do that and lower the risk for myself as much as possible. So that's another thing that kind of made it like a no-brainer for me.
So safety is very, very high on your list of importance. What do you think, what has brought you to having safety as such a priority at, this this young age of yours? Because normally it tends to normally be the other way around. So when the older we get, the more risk adverse, right? Versus when you're younger, you're like, well, I have time to be able to fall on my face or to figure it out or to make mistakes and things. But you right now going, you're saying, hey, I'd rather start putting my into spaces to where I'm safe at the start and I'm safe at the end.
My whole life I've kind of always known that like I really have to secure myself like financially. I really have to make sure that I'm in a good place, that I'm like in a safe place, just because I don't have like that type of security net around me, within my family, like financially. My family's not really in that place to where someone else could like take care of me, essentially.
Got it.
So that has been like my biggest motivation, like throughout life, making sure that everything I do is for the purpose of like making sure that I'm good. Because people who know me, I've said this like several times, like I don't like problems, I don't like stress, I like to be at peace. So these are just some of my core values that I'm working towards.
Okay.
Yeah.
So this is your peace of mind plan right here for a prosperous and promising future.
That's what I'm calling.
I like that.
Peace of mind plan.
It's the peace of mind plan. That's it. My preferred peace of mind plan, right?
Exactly.
Because that makes a lot of sense. Because I think that in my conversations, mostly it's people prioritize different things. When I said, it goes back to what's the most important thing to you financially. Some people want to be able to make and save money. Other people want to have a guaranteed income. They focus on long-term care. They want to have more avenues for tax-free cash. They want to, like, everybody has a different take based on where they're at in their life. Are they in the contribution phase? Are they accumulating wealth? Are they looking to be able to distribute their wealth? Are they making sure that it's going to be there when they need it most? And that can always fluctuate and vary. But being that you're in that space and you're thinking safety first, this right here, have you ever played sports?
Cheerleading briefly.
Okay, all right. So I don't have a cheerleading analogy, right? But you cheerleaded for sports. You have, in all of these different financial avenues, you have offense and you have defense. Have you ever heard the phrase defense wins championships?
I believe so.
Let's go with that fact that you did, right? Or maybe they have, right? This is your defensive powerhouse for whatever else that it is that you're doing. So when you're thinking about, okay, what do I want out of where I'm putting my money? Okay, I'm getting safety, I'm giving guarantees, but really at the end of the day, I'm playing defense. So when the market goes low, we're fine. When the market goes high, we get to participate. So we're happy on both ends, no matter what happens. That, hey, listen, when things are doing great, excellent, wonderful, let's go ahead and let's all celebrate. Right. When things are going bad, you're not stressing. You're not having those certain conversations of, well, what position will I be in based on these external circumstances?
Right. We're not asking how to recover this from this loss.
Because I mean, if you think about it in other areas, if you have, let's just say it's in the stock market. If you have $100,000 in the stock market and you lose 10%, what are you at?
90,000.
You have 90,000. Now, if you gain 10%, you're at 99,000. So whenever you lose, it takes even more for you to get back to zero. Now, what if you're at 100,000? You have 100,000 in something like this, and the market goes down 10%. You still have 100,000. When the market appreciates 10%, now you're at 110. So the thing, so when you're just looking at, okay, where am I? What benefits do I want my money to really do? I want to get the gains, but I don't want the losses. I want to have access to make sure that it's not locked up. I want to make sure that I'm getting a return because, once again, I'm focused on the gains. And then if I'm looking at something, do I want my money to be taxed later, or would I rather the option for it to be tax-free? Just thinking of, where I'm doing things. And you can have your money all over the place, and maybe you're going to think that you can't have it all. But at the same time, with this, you can really check a number of those boxes of it being liquid, of it being safe, it giving you a return, having tax advantages, and then most importantly, also having a health advantage too. You tell me somewhere else that had all 5 of those things, then by all means, let's have that conversation, right? Mm-hmm.
Well, this conversation has been super helpful for me. Again, refreshing me on my own policy, and yeah, just a lot of the benefits that I've signed myself up for to get in the future. And I know it's definitely going to be the information is going to be beneficial once I share it in the clip versions, all types of versions with my followers, because it's really very important for me that people myself. It's super important for myself that I'm always able to make like an informed decision. I like to be able to make informed decisions, and I think just all of us we would all be able to make better decisions with more understanding information and understanding. So as I'm learning these things, that is my goal in sharing it with you all, as for us all to be able to make those smart decisions and informed decisions. Kadari, is there anything else you would like to share with the folks that you would like them to know?
Well, two things. First, I want to give you your flowers and say that you making the decision to be able to improve your situation and not just taking the knowledge but applying it, because some people say knowledge is power, but it's really the application of it. It's like what am I going to do with this now? So taking that and taking that and then taking control of your situation to be able to benefit yourself for now into the future as you evolve, as you grow as a person and so on. So for the fact that you've taken a significant step in this journey of life, good for you.
Thank you.
It means a lot, right? Second, if anybody wants to find out some more information, right, they can follow me on Instagram, IJS_KD, like I'm just saying, _KD. So IJS_KD. Loving to have conversations about economic education, leaning into life insurance, annuities, retirement solutions. Very, very big emphasis on the long-term care and the need for ourselves. And then also recently talking about telehealth, so people can get access to urgent care and virtual consultations and specialists from the comfort of your own home. So we're finding a lot of ways to be able to open doors, to be able to educate people so that they can make those informed decisions. And at the end of the day, I mean, you can never really know too much about finances, but regardless of what you know, what are you applying and why are you applying that? And then where are you looking to go with all those reasons?
Wonderful. So I'm going to share this live. I'm going to tag Kadari in it. And so, like you said, if you'd like more information, you can reach out to me. You can reach out directly to him. And I hope y'all find this as beneficial as I did. I know you will. And yeah, there will be more topics to come. And so until next time.
Yes, indeed. Thanks for having me.
Thank you for joining me.
Take care.